Is it possible that the government being shut down is what's causing the markets to crash? The markets have been especially volatile lately, seeing single-day drawdowns of 3%, followed by large recoveries and followed again by large drops and intraday bounces, especially considering that this government shutdown is now the longest shutdown in history. Is it possible that this is what's causing most, if not all, of the volatility in the markets, and how so? Well, the first way the government shutdown is contributing to the recent volatility in the market is because of this account, the Treasury General Account. This is the government's checking account. So when they take money from you in taxes or when they borrow money, it's going to go into this account. And then anytime they spend money on anything like Medicare, military contracts, dropping bombs in the Middle East, it's going to come out of this account. And what you'll notice at the tail end of this chart is that it's just been moving up. And if we zoom in on just the last year or so, we can see that this recent spike has basically gone directly up in a straight line. And it is now around $940 billion. You can see prior to the last dip, this account balance was holding somewhere in the $700 to $800 billion range. And this is where the Treasury likes to hold this account. They like to have at least a couple of days worth of pure outflows, and considering how many T-bills the government is rolling over on a daily basis, they need to have about $850 billion in this account pretty much at all times, which is why they were intentionally building this account back up before. Now, just like you, if your checking account is to increase, it means you need to have more money coming in than money going out. And so that's exactly what the US government has been doing over the last few months. It's been taking more money in taxes and borrowing than it has been spending in order to build their checking account back up. But they have overshot their target, which was $850 billion. And they've overshot it by about $100 billion at this point. And that is directly a result of the current government shutdown. Now, you might be wondering how that's possible, given past shutdowns have caused their Treasury General account to shrink to almost zero. And that's because there are different kinds of government shutdowns. You can have a government shutdown because of a debt ceiling issue. In that case, the government can't borrow, which means the only money coming into their account is from taxes. And most of the taxes come in around tax time. And so if the government shuts down from a debt ceiling issue, they're going to be spending money from their checking account to keep up all their expenses. And then once it gets dangerously low and they are at risk of defaulting on the national debt, Congress suddenly comes together for a deal and they're able to start borrowing again, refilling the account. But as you can see, ever since the government shut down over a month ago, this account has been increasing this time. And that's because it's a different kind of government shutdown this time. It's not a debt ceiling issue. This is a discretionary budget issue. In other words, for all the money that the US government is going to be spending, a big chunk of that is already decided ahead of time. That's the mandatory part of the budget. It's the big things like Social Security, Medicare, Medicaid, and interest on the debt. Just those things soak up pretty much the entire taxable income that the government takes from us. Everything else beyond that is considered the discretionary portion of the budget that Congress can decide on to figure out how they're going to spend it, even though they've already spent all the tax dollars. But right now, the government is shut down because the two parties have not come to an agreement on how they're going to spend that money that they don't have. They're just borrowing it. This would be like you and your spouse having a fight about how to spend the money that you're going to put on your credit card. And because you can't come to an agreement on whether you're going to go out and party or whether you're going to go on a shopping spree, you can't spend anything until you come to a decision. And that's why the checking account has been growing for the government, because they're still taking money in taxes and they're still borrowing. They're just not spending most of it right now. Now, the government's checking account, this Treasury General account, it is held outside of the banking system, which means every dollar that they take in taxes and borrow is money that's leaving the financial system. It is sucking liquidity away from banks and away from the economy. This is why financial institutions' usage of the Federal Reserve's repo facility has spiked recently. The repo market is where banks go to get overnight liquidity from each other. And when there's not enough of it to get from each other, they can just go to the Fed and get it directly from the Fed. This has been increasing lately because the government has been sucking so much liquidity out of the system that they need to tap the Fed to get it. Now, if this sounds anything like quantitative tightening, that's because the effects of it in the short term are similar. Quantitative tightening is when the Federal Reserve's balance sheet is declining. It's when the Federal Reserve lets assets bleed off their balance sheet in exchange for cash that they destroy. It removes liquidity from the system. They did announce that they're going to be ending quantitative tightening, but not until December 1st. And so there's still almost a month until the Fed stops doing quantitative tightening and they stop sucking liquidity out of the system. So between the government's Treasury general account growing from the government shutdown because they're taking more than they're spending, and the Federal Reserve's continued quantitative tightening until December 1st, we are seeing stress in the financial system, a lack of liquidity. Now, this is not going to cause any problems like bank failures or anything like that because these financial institutions can always just tap the Fed for the short-term liquidity they need. Also, this is a short-term problem. The government shutdown is going to end at some point. It's just a matter of when, not if. And the Fed's quantitative tightening is coming to an end on December 1st. So all this liquidity that's getting sucked out of the system right now, number one, it's coming to an end at some point soon. And number two, when the government shutdown ends, all of that money they haven't spent yet is all going to go get spent. All of the people that they haven't been paying their paychecks this entire time are going to get all that money that's just being held in the government's checking account right now. Which brings me to the third reason why the government shutdown is leading to so much volatility right now. And that's because all the people who are missing paychecks from the government shutdown. At least 670,000 federal employees are furloughed right now, and about 730,000 are continuing to work without pay. We also have 1.3 million active duty personnel and over 750,000 National Guard and Reserve personnel that are also required to serve, and some of them without pay. If this continues for another week, then we could see November 14th be the first time in history that members of military branches will miss a paycheck due to government shutdown. Now, the reason why this could be contributing to volatility in the markets is because, number one, if these people are not getting paid, it also means they're not making contributions to their retirement accounts. Most people are not aware, but the vast majority of the impact on the markets over the last 50 years or so has been more and more automated buying in retirement accounts into index funds. People get paid, a chunk of that goes into the overall stock market to buy it, regardless of the value, regardless of the stock, regardless of the composition, regardless of the fundamentals, regardless of anything other than the fact that I have money, so I'm going to buy. And so when that shuts down, even though it's for a small chunk of people, it's still a significant amount of buying that was there before and is no longer there right now. But that's not the only thing that's going on here, just a lack of buyers. A lot of these people are actually probably sellers. Goldman Sachs recently did a survey about a month ago and found that approximately 40% of people reported that they are currently living paycheck to paycheck. 40% of Americans are living paycheck to paycheck. Now, I don't know how many of those are working for the government and how many of those who are working for the government are currently not receiving paychecks. But the number is certainly not zero. Considering that 40% of people are living paycheck to paycheck, it means that not all these people are just dirt poor. Yes, certainly, some of these people have no choice. There is a floor underneath expenses just to stay alive. But for 40% of Americans, that is not true. It's bad financial decisions and bad financial habits. I remember when I first started my career and I was making $40,000 a year with my wife staying at home with our newborn, and we felt like there was no room in the budget. It was rough. It was tough, but we still stuck to the budget. We shopped sales, didn't live beyond our expenses, or didn't live beyond our means, didn't have any debt. I was still contributing a percentage, which was a small dollar amount, but still contributing a percentage to our retirement accounts. And we had an emergency fund. So it felt like we were living paycheck to paycheck. So maybe if I was surveyed at that time, I would have said yes to that as well. But Bankrate just did a survey last month as well that found that 60%, almost 59% of Americans don't have enough savings to cover an unexpected $1,000 emergency expense. 60% of Americans. So yes, the bottom end of that's going to be because you simply just don't make enough. But the top 20 or 30% of those people, that's bad financial decisions. You don't have enough to cover a $1,000 unexpected expense. That's because you are living beyond your means. And a good number of the people who are working for the government and now are not getting paid fall into that bucket, which means if they do have anything in their retirement accounts, if they do have anything in a brokerage account, they're currently selling. Now, this is impossible to quantify, but it is almost certain that it is at least contributing somewhat to the volatility in the markets. Between the lack of liquidity across the financial system, the lack of buying, and the possible selling by everybody who works for the government that's not getting paid right now, I would not be surprised at all to see the volatility in the markets continue until this government shutdown ends. And just so you know, when the government shutdown ends, all of that money that hasn't been spent, that would have gotten spent this whole time, is all gonna go out basically at once. So the tightening effect from this is temporary, and over the long term, the net effect is absolutely zero. The Treasury general account, money goes in when they take it, and money goes out when they spend it. So the Treasury, the government itself, does not do QE or QT or have that effect over the long term. The Federal Reserve does, not the government. And so once this shutdown ends, there's gonna be a flood of money back into the financial system. Oh, and also, like I mentioned before, the Fed's quantitative tightening is ending December 1st, which means that their withdrawal of liquidity from the system is ending December 1st, and they're engaging in an Operation Twist, where they sell mortgage-backed securities off their balance sheet and use that cash to roll over into T-bills, which has a somewhat of a QE effect on the markets. And that's starting on December 1st. By the way, guys, I just got a reply from one of the subscribers to my free newsletter. And he said, "Dear Joe, your letters are great. As with most of us, I really am tired of emails, but I look forward to reading yours." So that is really saying something. If you'd like to see what the buzz is about and see me in your inbox with insights and stories that I do not talk about on YouTube, the link to sign up for my newsletter is in the description below. As always, thank you so much for watching. Have a great day.